Welcome to this video on the 30 mistakes supply and demand traders often make. In this guide, we will walk through common pitfalls to help you protect your capital and your peace of mind while trading. We begin with part 1. Misunderstanding the zones. Improper identification of these areas is where many traders first go wrong. Mistakes 1 through 3 involve zone identification, creating static zones, forcing zones where they don't exist, and poor base marking. These errors can lead to inaccurate entries and improper stop-loss placement. Mistake number 4 is ignoring dynamic liquidity. Market conditions change constantly, and simply drawing a rectangle on your chart doesn't guarantee that buyers or sellers are still present. Mistakes 5 through 7 concern zone quality. Watch out for weak departures from a zone, the trap of retesting exhausted zones, and maintaining too narrow a focus that ignores the broader market trend. Moving to part 2, we examine execution and timing errors that can compromise your trades. Mistake number 8 is a lack of patience. Chasing price after an aggressive move has already occurred is a common error. Successful trading requires waiting for a pullback to the origin of the imbalance. Mistakes 9 through 11 relate to entry problems. These include entering trades prematurely, ignoring confirmation signals, and failing to correctly read the current order flow. Mistakes 12 through 14 focus on fakeouts and liquidity. Traders often fall for traps in thin liquidity, fail to recognize the magnet effect of stops, or trade during low-volume sessions. Mistake 15 is the fakeout trap. This happens when you jump into a trade solely because price touched a zone boundary, without waiting for the necessary candle close confirmation. Next is part 3, which addresses the importance of not missing the big picture. Mistake 16 is ignoring multiple timeframes. Trading a lower timeframe supply zone while the daily trend is strongly against you is a common and dangerous mistake. Mistakes 17 through 19 involve environmental blindness. Be aware of high-impact news events, understand shifts in market regimes, and recognize correlations between different assets. Mistakes 20 through 22 fall under analysis paralysis. These involve cluttering charts with unnecessary indicators, confirmation bias, and failing to observe how price actually approaches a zone. Finally, we arrive at part 4, risk and psychology. These final elements are essential for long-term consistency in your trading journey. Mistake 23 is poor risk management. Traders often incorrectly believe that a supposedly perfect zone guarantees a win, leading to oversized positions. Remember, even the best setups can fail, so maintain strict position sizing for survival. Mistakes 24 through 26 concern your exits. Avoid setting stops too tightly, which invites liquidity sweeps. Steer clear of unrealistic targets that ignore opposing zones. And do not move your stop to break even too early, as this can choke a trade before it has time to develop. Next, we address psychological traps. Mistakes 27 through 29. Avoid FOMO entries that destroy your risk-reward ratio. Do not revenge trade after a loss, and always maintain a trading journal to learn from your mistakes instead of repeating them. Finally, mistake 30 is expecting perfection. Supply and demand trading is a probabilistic framework, not a magic formula. The markets are chaotic. View these zones as areas of interest where the odds may lean in your favor, and accept losses as a standard cost of doing business.